Alrighty. So today's video is on the ultimate guide to choosing the right option income strategy for you, right? So I understand that there are a number of you guys who are just relatively new to trading options, because I've got a number of people who reach out to me to ask, which kind of option strategy should they use. So if you are at different stages of your journey, then there are different types of strategies that you should be using, right? So for example, if you are just brand new, then there are certain strategies you should not be using. At the same time, if you already got a pretty sizable account size, then there are certain strategies that you do want to use, so then you can get more consistency in terms of your profits, right? So this video will serve as a framework, a guideline for you, because really there are a plethora of strategies that you can use, and it's very easily for you to get confused if you're not sure. All right, so let's get into this video. So first off, there are three categories that you might belong to. So the very first category is that you're the stock investor. So maybe you have a long-term stock portfolio and you have at least 100 shares of a stock, and you also don't mind buying at least 100 shares of a stock moving forward. That means you do want to grow your stock portfolio. That means you want to add on more stocks. Then you will be considered the stock investor. Now the next category is the small account trader. So this is where a lot of people are at as well. So this is where you are relatively new to trading options. Maybe you have never traded options before, or maybe you have actually put on some trades, maybe demo trades, or up to maybe 10 live trades so far, like credit spreads and stuff like that. And you do not have a large account. Maybe you have an account size of less than $50,000. Then I will categorize you as the small account trader. And then after that, you have the medium to large account trader. So this is where you have some experience under your belt already, right? So you have maybe been trading options for some time, right? And you have a trading account size of at least $50,000 and above. So these are the three different categories. Now, it's not necessary that you only belong to one category, right? You could be a mix of the different categories. Like for example, you could be a stock investor where you have maybe $1 million in terms of portfolio, but then you're new to trading options and you're just getting your feet wet. So you want to just start off with a small account size. So you could be a stock investor and a small account trader, or maybe you could be a stock investor and a medium to large account trader. You have already put on some number of trades in terms of options, and now you want to grow your account. Or you could be, someone that is relatively young. Maybe you just graduated out of college, or you just started in the workforce, so maybe you're just starting off with a small account. So it could be a mix of either of this or just one of these fields. So I'm going to share with you the different kind of strategies that you can use for each of these categories. So starting off, we have the stock investor. Right, so as a stock investor, right, chances are you have long stock positions, and the easiest option income strategy for you to use is none other than the covered call, right? So for the covered call, basically what you want to do is to see first whether you have at least 100 shares of stock in your account, right? If you have 100 shares or more, then you can sell a covered call, because each option controls 100 shares. So you want to make sure that you at least have 100 shares of a stock, right? So the covered call is a very simple and straightforward strategy, and it's simply just selling a call option against 100 shares that you have, and then you get paid a premium, right? Very simple as that. So let's say, for example, you have Amazon, right? Let's say you bought Amazon, you got 100 shares at 94.9, right? So for you to just generate an income, the quickest way is to sell a covered call, right, above where you bought your stock at, right? So let's say, for example, in this example, I use 105, and then let's say you receive $1 for this. So each option controls 100 shares, so $1 would equal to basically $100. So you receive $100 straight away into your account just by selling this covered call. Now, you might be asking, Davis, what happens if the stock actually goes above your covered call? Well, two things, right? So first of all, if the stock price goes above your covered call, and let's say it settles there by expiration, then first of all, congratulations, you have just made money on your shares, because not only have you received $1, which is $100 in terms of income, premium, you also actually made money on your shares, right? You made the capital gain of about $10, right? From $94 all the way to $105. So this will be your profits, two profits in terms of premium and capital gains. Now, the other thing is that you might be saying, But Davis, I want to hold on to this stock for the long term, right? That's the reason I want to have a long-term stock portfolio, right? So that I can hold on to it for the next 5, 10, 20 years. So if that is the case, then guess what? You can just simply roll your covered call, right? By rolling your covered call just simply means to move this covered call to a higher strike price. Well, the intricacy of what it is closing this covered call and then selling another one, and at the same time you also can get an additional premium for doing so. Now I won't go into the in-depth, right? I won't go in-depth into rolling cover calls because I've already created a video specifically on that. You can just go to my channel and just find that video to watch that. I go into all the different strategies that you can use in terms of rolling your cover call. But what you have to just understand is that if the market goes up, you do have options, right? It's not necessary that your cover call will get your shares called away. So additionally, if there are still stocks that you want to buy because you are still building your stock portfolio, then the second option income strategy you can easily use is the cash secured put. So what is the cash secured put, right? So this is also coined as the Warren Buffett strategy, right? Some people like to call it the Warren Buffett strategy or the get paid to wait strategy. And the reason it's called the Warren Buffett strategy is because Warren Buffett have actually used this to get into certain stocks that he actually wants to own for the long term. So for example, let's say for example, you want to buy Amazon. Right? And Amazon right now is at $94.90, and you think to yourself, you know, it's a little bit expensive. I want it to be a little bit cheaper. I want to wait until it's $90 before I actually buy the stock. So there are two ways you can do it, right? The first way is you can just simply place a buy limit order at $90. So if the stock goes down, then you will get filled, right? That would be the most straightforward and simplest way which most people use. Now the second way, instead of just placing the buy limit order and just waiting for the stock to come down, which it may not because the market can just shoot up, then you could just sell a put option, right? This is what you call a cash secured put. That means to say if the market goes down, by expiration it's below this strike price of 90, then you will be executed, right? You will be buying these shares, 100 shares at $90, which is what you originally intended to at the first place. On top of that, you get $200 because you sold this for $2, right? So you get $200 on top of buying the shares at your desired price, right? So that's how you can get an income. And if the stock does actually go up, it doesn't go below this strike price, doesn't stay below there by expiration, then guess what? You can actually get $200 when you wouldn't get it if you just place a simple buy limit order. That is why it's called the get paid to wait, right? So you just sell an option and you wait. And if it goes down, you get 100 shares. If it doesn't, you get the premium, right? By the way, this premium, you get it regardless whether it goes up or down, because the moment you sell this put option, the premium is yours, right? It's already put into your account. So these are the two strategies you can immediately use as a stock investor, and you have at least 100 shares of stock. Alright, so the next category is the small account trader. So if you're new to trading options, right, or maybe you've just placed a few trades or maybe into demo trading, or you have a small trading account size that is less than $50,000, then there are simply three strategies, right, that you can just start off with. And I call this the triple threat. And the first of which is the bull put spread, right? So the bull put spread is also known as the vertical spread or the credit spread. But what's important for you to know that this is a neutral to bullish option strategy, right? So basically, it is a defined risk strategy whereby your maximum risk is capped, which is very good for you if you're just starting out, right? Because if you're just getting started, you definitely want to have, those kind of strategies where you cannot have a big loss at any one time. So this will be a very good way for you to get your feet wet, which is a bull put spread, where the way you do this is basically just by selling an out of the money put option. So basically, let's say the price right now is at 103.51. So we sell an out of money put option, which is below the current stock price, right? And then you buy a further out of the money put option to cap the maximum loss. So your maximum loss can only be the width of this spread. So maybe this width of this spread could be $5. and then you minus off the credit which you receive. So maybe if you receive $1 in terms of credit for this, then the maximum loss you can make is only $4, which is $400, right? So with this bull put strategy, it is a neutral to bullish view. That means to say that the market does not necessarily have to go up in order for you to make money, because the market could just stay somewhere around where you first entered the spread. In fact, it could even drop below where you first entered it, as long as it's above your short strike. So as long as it expires above this short strike, then you'll be able to make the full premium on this strategy. Next, you have the bear call spread. So for the bull put spread, it is a neutral to bullish view, whereas the bear call spread is the opposite, right? It's the neutral to bearish view. So similarly, you'll be selling an out of the money call option, and then you buy a further out of money call option to cap the maximum loss. So again, same thing, the market can just trade up, trade against you, but as long as it does not expire in the money, which is above your short strike, as long as it expires anywhere below your this short strike, then you'll be getting the full credit on the bear call spread. And finally, the last of the triple threat strategy is basically the iron condor. So the iron condor is just the combination of the bull put spread and the bear call spread. So this is when you have a neutral view of the market, right, of the stock or the index ETF, or if you can't pick a direction, right? If you cannot pick a direction, you're not sure if the market going up or down, then guess what? You can just simply use the iron condor, because with the iron condor, what you're doing is you're basically just trading the expected move. Now, I talk about this term, the expected move, in another video, which is very important. So I want you to go and watch that if you're not very sure. That is, I've labeled the video the #1 secret to trading options consistently. So go and watch that if you're not sure what the expected move is. But basically, the iron condor takes advantage of that, right? So as long as the market stays within this range, right, from your these two short strikes, then guess what? You're going to be able to profit on the full premium of this iron condor. So all you need when you're just starting out is just these three strategies, right? Just these three strategies would have basically encompassed all the movements in the market, right? If you are bullish on the market, use a bull put spread. If you think the market is going down, then use a bear call spread. If you're not sure where the market is going, or you see that the market is going sideways, then you can use an iron condor. So in all the market's conditions, all the situation, you have it all covered with these three strategies. So there's no need for you to go and look for any other strategies for now. Don't bother about the put ratio spread, the broken wing butterfly, the short put, all the other stuff. For now, when you're getting started, these three strategies is more than enough. Now, the next question you might have would be, when do I use which strategy? How do I know when to use the bull put strategy, when to use the bear call spread, when to use the iron condor? Well, then I'm going to give you a very simple framework for you to identify, which strategy to use at which time. And the simple way to do that is by using this stochastic oscillator, right? So if you're not familiar with what a stochastic oscillator is, it's basically an indicator to identify the condition of the market, right? So the market can either be in an oversold condition, whereby basically what the indicator is trying to do is trying to find where the market have really sold off a lot, right? So that's why the term is called oversold. Or if it's in an overbought market, where the market has already bought up quite a bit. And then there is the one in the middle. So basically, this is where the market is neither overbought or oversold. So as you can see, again, it has already encompassed the three different market conditions. You have overbought, oversold, and then when it's neutral. So with this, how do you identify which strategy to use? So you only find bull put spread opportunities when the stochastic oscillator is oversold, right? So let's say, for example, at the end of this chart down here, you look at the oscillator and it says oversold. If it says oversold, then guess what? You do not bother about iron condor strategy. You do not bother about the bear call strategy. All you want to do right now is to find opportunities to enter into a bull put spread. So how do you want to enter into bull put spread? So generally what I would suggest is to look for support level. So for oversold, because we are looking for a bullish strategy, a bullish view with the bull put spread, then you want to find support areas, right? So support areas could be basically previous lows. So all this could be support areas, or it could also be dynamic moving averages, right? So this moving average can serve as dynamic support areas. As you can see, sometimes, you know, when it comes to this line, it goes down. All right, so the way to place the bull put spread will come down to a little bit of discretion for you down here. So if you say that, you know, this could be it serves as a support, right? So what you could do is then you identify the short strike of your bull put spread to be below this line. So maybe you look at the option chain and you say, okay, I would like to see whether, you know, I can get a sufficient premium at 132. So maybe go for 132 and then buy a further out put option. So you have -1 put option and then you have +1 put option. So this is your bull put spread. Or let's say, for example, you say that, you know, you want this support because you think that this support is going to hold. Then guess what? You don't enter into a bull put spread just yet, right? You just wait. All right. So let me just remove this. So basically what you want to do is you want to wait for the stock maybe to drop a little bit further first, and then you start to sell the bull put spread below this support level down here. So -1 and then +1. Okay, so you only find bull put spread opportunities when the stochastic oscillator is oversold. Now next, only find bear call spread opportunities when the stochastic oscillator is overbought. So this is on the opposite side. So if you see the stochastic oscillator is overbought, then guess what? You only look to find bear call spread opportunities and don't even bother looking at iron condor or the bull put spread. So in this case, what you want to look for is previous highs, right? So resistance levels, or you can look at dynamic resistance with the moving average. So again, the same thing, you want to try and, as much as possible, place your bear call spread above a resistance level. So let's say, for example, at this point, you see that the market is oversold, then of course you won't be looking for bear call spread opportunities. You want to wait for this to go up. So once it's at this point, then you look at the previous resistance level and see whether you are able to sell a bear call spread where your short strike is above this resistance level, right? So you have the short put down here, sorry, the short call down here, and then you long a call above down here. Lastly, you have the iron condor. So you put on the iron condor when you can see that the market is neither overbought or oversold. So this is much more straightforward. So if you see the market is neither overbought nor oversold, then you can just go ahead to place an iron condor trade. So this way, it makes things simpler. So this is just a way for you to get started. Not necessarily this is the end all and be all or the definitive only way that you can place on these trades. Because you are just getting started, then it's good for you to place one trade at a time and just get an experience, get a feel for it. As you get more experience, then you can start to place, you know, bull put spread, bear call spread, iron condor at other places at any other times where you feel or you deem necessary. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. And finally, we have the last category, which is the mid to large account trader. So for this is if you have a trading account size of more than $50,000 and you have quite a bit of experience trading options already, quite a number of trades you have made, and then you have more choices of option strategies to use on top of the strategies for the small account trader, which is the triple threat, right? So on top of the triple threat strategies, there are other strategies you can use now because you have more capital to play with, right? So one of the other strategies you could use is the wheel strategy. So the wheel strategy is pretty popular and also pretty straightforward and simple to understand. Basically, it's a combination of the cash secured put and the covered call. So if you recall, in the very first category, the stock investor, right, basically you have been using cash secured put to get into your long-term stock positions and then covered call on your existing stocks, right? So for the wheel strategy, it's pretty much the same thing. It's just that now you're no longer in a long-term thinking mode, right? You're no longer thinking of holding the stock for the long term. Instead, you're just getting in and getting out whenever you can using the options. So how it works is simply this, right? So it's a wheel strategy because as you can see from this graphic which I have done down here, it is pretty much a wheel. You start out by selling a cash secured put, right, at a place where you want to get long 100 shares. So let's say if you are assigned 100 shares, then you can start selling the cover call. But if you are not assigned 100 shares, guess what? You can sell the cash secured put again, and you can just keep selling it until you finally get assigned. And once you get assigned, sell the cover call. If your cover call expires worthless, sell it again. And then once it get exercised, your shares are called away, and then you start this whole cycle all over again. So there are three ways for you to get an income from the wheel strategy. Well, first of all is by selling the cash secured put. This is where you get premium. This is for the income number two, you sell cover call. This is where you get premium as well. And then finally, income three is capital gains from the stock. Basically, it's where you enter and where you exit. So if you bought the stock at $90, you got assigned on your cash secured put at $90, and then you sell your cover call, let's say at $95, then guess what? You will be getting the capital gains of $5 per share. So if you have 100 shares, there'll be $500 on top of these two premiums which you have gotten for selling the cash secured put and cover calls. Now, other than the wheel strategy, right, there are other strategies that you can use, and the quickest way for you to profit if the market goes up would be with the short put, right? So this is your classic vanilla option strategy. That is the short put, and the short put is the quickest way to profit the market goes up because you have three things working for you, right? So number one, you have positive delta, right? Because you have a short put, this is a neutral to bullish strategy. So you want the market to go up. So if the market goes up, naturally, you'll be making money on your short put option. Secondly, you have positive theta, right? So unlike the credit spread, which is the bull put spread, iron condor, the bear call spread, unlike that, you do not have any long options, right? This is just a pure classic vanilla short put, just one short option. And because you have just one short option, you have pure theta. If you have a long option, then you'll be losing money in terms of theta down here, whereas you'll be making money in terms of theta on your short option. So these two will kind of have like a friction, right? So you have positive theta working for you, because one thing we know about options is that by expiration, all extrinsic value will go to zero. So you have time decay working for you in your favor. And lastly, you have negative vega, right? So basically you're profiting from a collapse in volatility, right? So if you don't really know, then option pricing, how they price the options also got to do with implied volatility. So basically the higher the volatility, the higher the option premium prices are. That's where you can sell much higher in terms of premium, and the lower the volatility, then the option premium pricing will be lower. So what happens is that ideally when you want to sell the short put is when the market goes down. This is when you want to initiate the short put position, because most of the time we are contrarian traders. When the market goes down, we sell the put option, we get a huge premium. And guess what? When the market goes down, the implied volatility goes up. And when the market goes up, most of the time, right, the implied volatility goes down. So this way, you also make on your short put, right? So you have three things going for you. You have the direction going in your favor because it's going up. Then you have positive theta because as time goes by, the option is decaying in its value, which is basically giving you the profits from the premium. And then you have negative vega working for you because the implied volatility is dropping, which helps you even quickly get the profits off from the premium, right? So short put is the quickest way for you to profit if the market goes up. Now the next strategy is the put ratio spread. So the put ratio spread is a very interesting strategy. It's one of my favorite strategy because this is like a hedge, right? So you essentially have with the put ratio spread is a short put. So if you think about it, is one short put, and then you have a long put spread, which is a debit spread, right? You have a put spread because you buy a put option here and then you sell another put option, right? So you have a short put and you use the credit to buy a long put spread. So in this case, you have what you call a put ratio spread. So this is what you call an omnidirectional trading strategy, because when you put on this put ratio spread, you're going to have a credit as well. You're going to receive a premium upfront because ideally you want to have the premium for the short put is more than what you pay for the put spread. All right, so let me just put it this way simply. Let's say, for example, you sell the put for $2. If you sell the put option for $2, then you want to buy a put spread for less than $2. So let's say, for example, you pay $1.50 for the put spread. So if you receive $2 for the put option and then you purchase a put spread for $1.50, then that leaves you a net of 50 cents, which is $50, right? So the market can go all the way to the moon for all it cares. You will still make money because you already have the premium upfront. And if it goes down, then guess what? You have the opportunity to make the maximum profit on the put ratio spread, because the maximum profit is basically below this long put strike down here. So if you were to take a look at the P&L graph down here, you can see this is of the put ratio spread. You can see that if the market goes up, all right, so this is where the current market price is. If the market goes up, you still make a profit because of the premium which you receive upfront. But if the market goes down as well, it doesn't matter, because you still have an opportunity to make even more money than the credit you receive. So as you can see down here, if your price so happens to stay within this tent, right, if it stays at this tent by expiration, then you're going to make much more than the credit you receive upfront for selling this put ratio spread. And I've created a video all about the put ratio spread as well. You can go ahead and go to my channel. It's called Make $10,000, Make Your First $10,000 with the put ratio spread, where I share with you my trades for the put ratio spread and the right instrument, the right product to trade the put ratio spread as well. And it is a very high probability strategy. So as you can see, this is around 89%. So you'll basically win more often than not. Now, last but not least is the strangle, right? So the strangle, if you recall, in the small account trader slides, I share with you the strategy of the iron condor, right? So the iron condor basically is the two credit spreads put together, the bull put spread and the bear call spread. Now for the strangle, it's very similar to the iron condor, except it does not have the protection of the long option. So in this case, you have just two short options, right out short options, pure theta decay, right? So the strangle, it can be quite intimidating if you're new to trading options, especially for a lot of new traders, because when they see the strangle, they will think that, hey, wow, this is really dangerous, because you know, you could lose an unlimited amount of money. Because if you were to pull up the option trade ticket, when you place on this trade, it will tell you that the potential loss is unlimited, right? And it's unlimited because it can go all the way to the moon, right? And there's no long option for you to stop the maximum loss. So this is where a lot of people get afraid, because they're not really familiar how strangle actually works. But although there is this unlimited risk, right, the potential unlimited risk, the chances of you actually losing, you know, an obscene amount of money is not that high. And the reason is because you have a time frame for each of these options. You see, so the one of the things that people have a misconception of is that if the market goes to zero, let's say for example you get into an individual stocks, and if it goes all the way to zero, you're going to lose everything which you have. You're going to lose more than what your account have. Now that is true, number one, if you do not have the right position size, right? If you put on too big for your account, then of course one single big move to the downside is going to wipe you out. Now number two, what you need to understand is that there is a time frame for each of these options. Like for example, if you put on this triangle, the ideal time frame normally you want to put is around 45 days, right? So let's say, for example, you put around 45 days. Now, what are the chances of a stock going to zero from 104 in the next 45 days, right? Now, of course, there are certain stocks, if you're unlucky, maybe you get into certain stocks like Enron or maybe Bestons during those times where it's going to go bankrupt. Now, of course, you're going to lose a lot of money. Or if you're so unlucky enough that you put on a stock where it gets, you know, acquired by another stock, another company wants to buy it over, then there's going to be a huge gap up on either side. So that is why, first thing, do not put it on individual stocks, right? When I trade a strangle, I only put it on index ETFs, because the chances of this having to happen, right, to gap up, is not as high as individual stocks. And index ETFs tend to move not as volatile as individual stocks. Number two, the option pricing, right, has already calculated roughly what is the standard deviation move, or where the market will be in the next 45 days. So where you're going to sell this short put and a short call options is roughly around the one standard deviation mark, right, which is around 16 delta, which means to say there is a 68% chance that the market will stay within this range. It is a pretty high amount, 60%. In if you actually go into the studies, you will see that most of the time the market will actually stay longer than this 68%. It will actually stay roughly around 71% to 85% of the time. And those times where it goes past this strike prices, is not that far unless you really hit those black swan events, like for example in 2020. But that is not enough to wipe out your account if you keep your trade size small. Alright, so I don't want to go too deep into this. I'll create another video to go in depth into the strangle. But for now, what you need to understand is that if you want to really get more consistent profits, especially if you have a large account, then this is where you want to start to get into certain undefined risk strategies, right? Like all these three strategies are all undefined. If you're just starting out, start off with maybe the short put first. Once you get a little bit familiar with the short put, then you get into the put ratio spread, and then you can get into the strangle. All right, so let's put it all together, right? I've given you so many different strategies. You may be confused. So let's give you a very simple framework, ask you a few questions, and then based on these questions, you can pretty much look at your portfolio and where you are in your situation, and then decide quickly which option strategy you can start using. So first of all, do you have at least 100 shares of a stock in your portfolio? If yes, sell a covered call, right? Go ahead and sell a covered call. At which strike, when to enter. Again, I have a lot of videos on the covered call on my channel. Go ahead and watch them. Next, do you have stocks that you want to buy for the long term? If the answer is yes, then sell cash secured put. Right? Because if you're already going to buy stocks in the first place, why just place a limit order and then you do not get any money out of it, right? Especially if the market goes up, it does not get your limit order filled. So what you do is sell a cash secured put. Next, are you new to trading options, right? If you're new, then you want to start off with just these three option strategies, the triple threat: bull put spread, bear call spread, iron condor. And then just pull up the stochastic indicator. If you want to know what settings to put on the stochastic indicator, again, I already have it on my channel. Go to the video where it says high probability setups using the stochastic indicator. Then you will see how I set up the stochastics. You can use that for yourself as well. So at the start, three strategies is all you need if you're new to trading options. So don't look to any other strategies for now. Master these three strategies. And next, do you already have some experience trading options and have an account size that's more than $50,000? So if you're already experienced, you already know what are all the different option Greeks, you understand how the prices move, you've already put on a number of trades, you have made money on some of them, then you can move on to the income grid review strategy. Again, I've created a video on this on my channel. And then also you can start other undefined risk strategies, the short put, the put ratio spread, and the strangle. And again, I've already got the video on the short put. It's called the short put mastery. I also have the put ratio spread, and I will create a video on the strangle in the future, so you can look forward to that. But for now, this is the framework for you to get started trading options. So hopefully with this video, you're no longer confused. You have at least a little bit more clarity than when you haven't watched this video, right? So at this point of time, go to see your portfolio, assess your situation, and then start studying the different strategies which you can start to use for your account. Alright guys, so I hope this video has been helpful for you, and if it has, just give me a thumbs up and also subscribe to my channel so you can get more videos like this. And by the way, if you haven't gotten your free copy of the Options Income Blueprint, then you can go ahead and get it at optionswithdavis.com/blueprint. Last but not least, I thank you for watching. I appreciate your time, and may the options favor you.